Hello, welcome to the video. Today is Tuesday, December 9th, and I have a lot of exciting information to talk about. And for those of you who are familiar with oil, or maybe you're trading any oil-related stocks, or you own any type of asset that's related to oil, you've probably seen some pretty rapid and kind of painful sell-off here the last few months. But I have actually the USO queued up, and this is the ETF. Basically, it's the United States Oil Fund. So if you want to have an interest, or if you want to trade oil and be able to do so with a diversified asset such as the USO, this is a great tool. And I'm going to go through as quickly as possible a trade scenario. I'm actually going to be building a position over the next couple days as we bottom out here, because I think we are getting close, and I'm going to explain my thought process right here on this chart. So basically right here is the this is a weekly chart. It's a 5-year weekly chart, and I honestly can't get too much information off of this because we've broken through this very, very strong support level around the 29.30 level. So I'm going to take it out to 10-year weekly, and you can see at the 10-year weekly, if I zoom in from mid-2008 to now, when we had our most previous low on the USO, we are nearing that low, and it is very conceivable that with the width of the DMI, which is one of the technical analysis tools that I use to kind of help get in and get out of trades and kind of just understand when you might have an oversold position, especially when you kind of coordinate that with the CCI down here, and this is called the Woody CCI. So there's a lot of different technical analysis tools out there, and these are two that work well for me. They're also, the cool thing about the DMI is that when you have an example, when you have these red and green lines this far apart, that is extremely rare, because you can see back here the last time you saw these two lines that far apart, it signals a very, very just rapid sell-off, and a lot of times you always have to revert back to the mean. So from a technical analysis standpoint, I like where this is, because we're hitting a huge support level that was created back in 2008, 2009. So it's a very strong level that I feel if you start building a position and kind of being able to use some advanced option strategies to mitigate the risk, because if it breaks this 2275 level with volume, then that's a sign that you probably want to get out of this, because it's going lower, because there's no other support in sight other than this 2275. So that's really the crutch point of where you put an alert, or whatever you have to do. If you watch the market on a regular basis, you'll be able to see if it ever breaks this level. But having an alert and being able to have some type of mental trigger if you break a level like this is very important when you're going into a trade, regardless of the duration. Just understanding those key support resistance levels is kind of a foundation technique that you have to be aware of. So looking over here, this is actually my platform here that I've traded on, and I want to kind of just zoom in here for you so you can see. This is the USO right now. It's currently trading at 24.14, and I've actually, my favorite option trading strategy and style is buying long-term options. They're also known as leaps. I've had a lot of success trading leaps, and it's definitely something that I have grown accustomed to and become very comfortable with when I put on positions that are large in size, because of a couple of factors. The first factor is the amount of time. So you see this little parentheses right here. I'm looking at the January 2017 option chain, and I'm pretty much looking at 15 different strike prices, because that's more than enough for me to choose from. And this is an example of all of the different options available in this specific month that has 772 days till expiration. So I currently like the 25 call options. There's about 496 exact open interest, so there's some interest in these options. The bid-ask spread is a little wider than I want. However, I feel if we can get filled at the mid price around 350 or 360 right here, then that is something that would be favorable to do so. The fact that we're bouncing off of the lows today at 20, I think I had a low today of roughly 20. Let's look at that actually. Let's take it up. Go to a daily chart, 1 day, 1 minute. So low today was right around this morning, 8:30, about 23.75. So we bounced off the lows, had some pretty strong volume to the upside today. So there it is conceivable that we are creating a base, but then again, it's been falling so far so fast that it's hard to solidify that. So one of the ways that advanced option traders like myself get into positions like this is you can buy a long-term leap option like this, January 2017 25 strike price call, and I can simultaneously sell a front month call option to bring down my call spaces. So I'm going to go ahead and show you what I mean here. I'm going to do all this live, so this is a real live account, and I'm not recommending you make this trade. Definitely do your due diligence. I'm not a financial advisor, but what I am is a professional trader doing this for 15 years, and I understand how the markets work, and I understand that when you have a scenario, when you have such a rapid sell-off like we've seen in the USO, that we haven't really seen in years. And just to kind of bring you back to the point, we have not seen, except in, of course, 2008 when we collapsed with the credit crisis, but that is really a point where we are hitting that low very soon. So why not get into a position when you're at historical lows on something like a U.S. oil fund, where we're going to have a rebound in the next 2 years at some point. And if you can bring down your cost basis and you can bring in some income while you buy this long-term leaps option, then that's a smart, high probability trading strategy going into this for 2015. So one of the cool pieces of technology that's available on this platform is the Analyze tab. And if I right click on this and I go to Analyze, I'm just going to do a single right now, and I'm going to kind of take it a little step further by I'm going to add a simulated trade, and I'm going to also sell. See over here, these are the volatilities on the monthly options. So if I'm buying the January 17, this is January 2017, if I'm buying them at a 26.6% volatility and then simultaneously selling something at 40 or 38% volatility, that's a good thing, because I have about a 10 to 12% volatility advantage, because I'm buying something that has the less premium, and I'm selling something with higher premium. So that skew, or that spread between those volatility is going to give you an edge. So if I go ahead and expand the December weeklies, this is actually the December 4 weeklies, so these expired 17 days. And I'm just going to look at these. I'm just kind of poking around with you. I'm doing this all live. But we have you can sell the December 4 quarterly. So these are the last week in December these options expire, because they're in red. They're the weekly options. Actually relatively new to the market. The weekly options have only been out for about a year now, so it's another tool that's ever increasing the market. They're always adding new assets and instruments and different securities and ways to trade, to bring in more transparency and bring in more tools for retail traders like ourselves to level the playing field with the pros and the market makers, and bring it so that we can have the same capability to have success in this business. And that's what I want to show you here with this. So I already have one queued up down here, and I'm going to also click this bid right here, and that's going to bring it down here. So now this is an example. This live price right here is what we're at. So we're at 24.05, buying one January 2017 call option, then simultaneously selling the December 4 2014 weeklies is basically going to give me a $3.50 debit. So it's going to cost me, instead of $3.85, which we're going to try to get a little lower on that mid price, I'm going to be able to bring in some free money by selling this front month option. Also, this is called kind of a calendar spread, and you can leg into these things, and legging in means you can buy the first part, like the January, the long-term options. You can buy those and then sell the weeklies or whatever short-term options you want. Maybe as you build a profit, or as things change, or whatever you want to do. So looking at this here, you can see my risk and so forth. Is this position, it's only one contract, so it's only going to cost about $350. So you can see that with $350, I'm controlling 23 shares of the USO. And that's what the delta means. For those of you that aren't familiar with the option Greeks, I have a lot more videos coming out where we can go into detail on that. But for this specific illustration, I wanted to explain a trade that I'm going to be building over the next few days and weeks into the end of the year. And this is the step one. Step two, I'm going to actually be executing this trade. I'm going to have a little analysis of where my thought process is, my exit strategy, my entry strategy, how much I'm going to put into it, and how this trade is going to manifest through 2015 and maybe into 2016. So my question for you is, does this interest you? Is this something you want to learn more about? Because if it is, then in the next video, I'm going to teach you and I'm going to explain even more depth how you would structure this trade and how you would position your exit strategy and what you're going to be using as your entry points. So go ahead and leave a comment or question if you have anything on your mind, and I will answer each one of those, and I will see you on the next video.